Hi, welcome to VetNet. Today's session, we're going to be talking about Wall Street 101 and starting a business with Brian Foran. Today's session is brought to you by IBMF, Institute for Veterans and Military Families. IBMF provides a variety of programs in entrepreneurship, career transitioning, and community outreach for veterans, service members, and their families. And now I'm going to pass the mic to Brian to introduce himself and get this presentation underdone. Brian.
Thanks, Elvis, and thanks everyone for joining. I'm going to spend most of the time today going through a slide deck. I just wanted to spend a quick minute up front, let everyone see who I am. My name is Brian Foran. I'm the co-founder of Autonomous Research US. We're an equity research firm, so we cover stocks in the US and we focus on financials. The presentation is going to have three parts. First, I wanted to give a Wall Street 101. I came at it with the perspective of someone who personally graduated with a finance degree, wanted to work on Wall Street, and was pretty clueless about what Wall Street actually was. The second part of the presentation is going to be focused on lessons learned from starting a business. And here what we did was survey about a dozen business founders over the past week for their key lessons learned and plucked out some common themes. And then third, we'll leave some time for Q&A on either topic or any others that are on your minds. So with that, we'll jump into the slides and maybe flip to slide 2, page 2. Just give a quick introduction of our firm on the left and myself on the right. So as I mentioned, we're a research boutique covering financial stocks globally. We have about 100 partners and staff in 3 offices. We cover about 200 stocks. We pride ourselves on being independent and unconflicted. So we're a independent firm. We have no investment banking. We have no trading. We just do research, and we have deep knowledge of the sectors we cover. I personally cover bank stocks and credit cards here in the US. So for those of you who are familiar with the tickers, Bank of America, Citigroup, JP Morgan, you can see the rest of them there. And I have about 17 years of experience covering and working with banks, primarily in equity research at Autonomous, and before that, Nomura and Goldman Sachs, and then also a stint in consulting in the early 2000s. So the first part of the presentation, slide 3, the Wall Street 101, and then quickly moving to slide 4. Let's start with what a typical big bank looks like these days. So the Wall Street bit is on the left. Usually it'll have a name like corporate and investment banking. Some firms will call it institutional clients group, slightly different variations on the names. But really what you're including here is investment banking, trading, large corporate lending, treasury management, and custody. So investment banking we'll get into more detail, but that's going to be your merger and advisory banker. Trading is going to be fixed income and equities. Large corporate lending is going to be what it sounds like, making a loan to IBM, Apple, pick a large company. Treasury management is going to be helping corporates manage their cash, so systems for tracking cash, accounts payable, accounts receivable, all that kind of good stuff. And then custody activities are going to be record keeping and the like for asset managers and large institutions. Just to quickly put it in perspective, a lot of what Wall Street is today is now wrapped up in a big banking model. So think of JP Morgan Chase or Bank of America. And basically you're going to have 2 other big lines of businesses within that model. In the middle, you're going to have retail banking. That's the easiest to understand. It's if you walk into a branch and it's there, that's retail banking. So it's deposits, it's mortgages, it's credit cards, it's auto loans, and usually small business lending. And then on the right, it varies a little bit more by company, but you're going to have some degree of asset and wealth management. That might be running mutual funds. It might be a retail broker. It might be high net worth client services. Different firms come at it from different angles, but those are usually the 3 main lines of businesses. So on page 5, let's flip the page and look at what a closer look at the Wall Street bit. So under corporate and investment banking, first, you're going to have the investment bank. That's typically going to include mergers and acquisitions, M&A. On the bottom left, ECM, equity capital markets, and then going further down, debt capital markets. So everything about issuing securities and advising companies. In the middle, you're going to have a trading division, FIC, which is the shorthand for fixed income, currencies, and commodities. So bonds, put simply, and equities. And then on the right-hand stuff, I just labeled it other stuff. Usually this stuff gets run a little bit separate. So when we talk about Wall Street, even though it's become divisions, corporate investment banking, all this other stuff is really a little bit of a separate animal. Let's go to page 6 and look a little bit at what the revenue trends look like. They're not good. So Wall Street's been a struggling place in the post-crisis era. revenues peaked in 2010, and they've come down generally most years since. Now, one of the things you'll notice on the chart on the left is just how volatile the business is. Some of that seasonality, almost always the first quarter of the year is the strongest and the fourth quarter of the year is the weakest. But a lot of it is just the nature of the beast. You come in every day, you start the cash register at zero, and you really have no idea, how much are stocks going to trade that day, how much a fund's going to trade that day, what is the profitability of those trades going to be, is there going to be a merger that goes through and you get paid, or does the merger fall apart for some reason? So it is a volatile business. It's one of the things investors always struggle with, how do I put a value on this? It's not like a technology company where you can just say, big market, they're executing well, it's going to grow 10 or 20% a year. On the right-hand side, we can just kind of see the current revenue by source. Staying on page 6. So fixed income, currencies, and commodities is still the biggest business. It's the one that's been under the most pressure, but it is still the biggest, followed by equities. Those two together are usually referred to as trading. So you can see Wall Street is still about 60% trading. There's been more growth in M&A, ECM, and DCM, collectively investment banking, but that's still only about 40% of the pie. Now let's flip to slide 7. Take a couple more looks at different revenue trends. So as I mentioned, Wall Street hasn't been a fun place the past couple of years. The 3-year revenue growth rate has been negative 7% on average. You can see by business, slightly negative in investment banking, modestly negative in equities, and then more significantly negative in fixed income, currencies, and commodities. That's been the biggest pressure point. In the middle, we can see revenues by firm, so you can get a flavor of who the big players are. JP Morgan's now the biggest firm on Wall Street, followed by Goldman Sachs. There's 2 points I'd make on this list more broadly. First, you can kind of read down the list and see very clearly a division between the US firms and the European firms. And this is global revenue, by the way, so it's not just looking at the US. One of the big stark trends over the past 5 years, the US firms raised capital quickly coming out of the crisis, they healed quickly, and they moved forward and quickly pivoted back to growth. The European firms went more slowly. They didn't really rip off the Band-Aid post the crisis, and they've been in various stages of retrenching ever since. So if I had done this presentation 5 years ago, the list would have looked different. It wouldn't have been all US on the top, all European on the bottom, but that bifurcation has emerged. The second thing is, while these are the 800-pound gorillas of Wall Street, the list of firms is really almost endless, including firms like Autonomous Research. So we have a little note there on the bottom. You'll see if I look at M&A as an example, there's 116 firms that advised on at least 500 million in deals last year. So you have a couple of really, really big firms on Wall Street, but you have an extraordinarily long tail of firms that specialize in a certain niche or a certain business. And then on the right-hand side, it is a global business. The US is still by far the biggest market, but it's now just below 50% of Wall Street revenues, and the rest is split between Europe and Asia, as you can see. So let's flip to slide 8 and take a closer look at investment banking. Now we'll go through each of the 3 businesses and just talk kind of plain English what they actually are. So you can see the revenue splits. Debt capital markets is the biggest. What is debt capital markets? Well, put simply, it's just helping a company issue bonds. It's also helping governments issue bonds, but it's really, when you say debt capital markets, it's synonymous with issuing a bond. So IBM wants to issue a 30-year bond and raise $2 billion. They'll call up Goldman Sachs or JP Morgan. They'll put the deal together. They'll sell it to investors. Equity capital markets is in the middle there. What's that? Well, it's really just an IPO. It's a little bit broader than that. It includes secondaries, but it's really when you hear about a company doing an initial public offering of their stock. So Sonos was a recent one that got a lot of press. For those of you familiar with the speaker company, when Facebook went public years ago, anyone going public is going to go to a Wall Street firm and get help and advice on the process of issuing their stock to investors. Last, M&A, well, what's that? That's really mergers. So one company wants to merge with another. The advisory bit is a little bit broader. You might be doing a restructuring. You might be doing a strategic move, a spin out or something, and bring in a merger banker to help with that. But really, when you say M&A on Wall Street, it's synonymous with a banker helping a company execute a merger, either as the buyer or the seller. So let's flip to slide 9. Equities, what is it? When most people think of equities, they're actually thinking of the very smallest piece of the business, which is cash equities. So the business of actually trading stocks. Really research, my job would fall under that as well. The biggest thing we do is support clients who are trading stocks and making investment decisions. But as I mentioned, it's become the smallest piece of the equities business these days. The two much bigger pieces are equity derivatives and prime services. So equity derivatives, just think of an option. If you're familiar with a stock option, a call option, a put option, there's a million different flavors of derivatives. But when you say equity derivatives, you're really saying options. The reason the revenue pool is so much bigger there is because the commissions are bigger. Cash equities, when I started, a lot of stocks still traded at 5 cents per share as a commission. Some people started before me remember 10 cents per share. If you look today, the average commission is all the way down to just over a penny per share. So as the business, the stocks still trade a lot, but the commissions generated on them are a lot smaller, and a lot of the money being made in equities has shifted to the derivatives business. Prime services, what's that? That's really supporting and servicing hedge funds. So if you're familiar with Citadel or Millennium or any of the big hedge fund names that are out there, they're going to need various services from Wall Street beyond just trading stocks. They're going to need someone helping to hold their cash, to lend them money, to give leverage. So they'll take their investors' capital and then borrow some money and lever it up. They're going to need record keeping, and a lot of that stuff falls under the prime services divisions, and really all of it falls under the prime services divisions. Servicing hedge funds in that way is one of the few areas of growth on Wall Street. You can see the dark blue line there. It's not hugely higher than it was in first half 15, but it is at least positive. So now let's go to the next page and look at fixed income, currencies, and commodities, try to demystify it a little bit. It's the biggest of the pieces of Wall Street. It's also the broadest. You can see whereas the other ones have 2 or 3 main pieces, this one's really got 6. So just to run through what's in there for each of them, starting at the top. Commodities, just think about trading oil. Obviously, there's lots of different commodities out there. You could be trading copper, you could be trading gas. But really the one that sticks in most people's minds is trading oil. You see someone talking about oil going to $75 yesterday, and what's going on with Iran and everything like that. That's really going to be the commodities divisions of the investment banks. Emerging markets, when you get into emerging markets like Latin America, like parts of Asia, really you treat it as a market as opposed to products. So in the US, you're going to go to market with a rates trader, you're going to have a securitization desk, you're going to have commodities. When a bank is dealing with Brazil, or they're dealing with Argentina, or they're dealing with Turkey, they'll really be looking at the country as a whole and service it off an emerging markets desk. Securitization, this is really taking any pool of assets, or really cash flows, I should say, and tranching them into bonds. So when you think about mortgage-backed securities during the financial crisis, or at least subprime mortgage-backed securities, that would go in securitization. Today the securitization business hopefully is a lot safer. And is a lot more focused on fairly plain vanilla products like tranching up corporate loans or funding credit cards. FX, this is foreign exchange. The FX is just a shorthand for the longer words. So think about it as a company is in the US, they're selling product into Europe, but their expenses are in US dollars. They're going to want to hedge that. They're not going to want to take the risk that all of a sudden their euro is down 10% versus the dollar and their revenues are down, but their expenses aren't. Obviously, there's many ways you might want to trade FX. It might just be pure speculation. But if you want to think about it just from a Wall Street 101 perspective, think about a company hedging revenues in another market. Let's turn to credit. This is really trading corporate bonds. It's a little broader than that, but again, if you just want a kind of key flavor, IBM issues a bond that goes through the debt capital markets business, DCM earlier. If the investor who owns it a year later wants to trade out of that bond, they're going to go to a credit desk, and someone on a credit trading or increasingly an electronic system is just going to help them do that. And finally, rates. This is really anything where the price is all about what's happening to interest rates. So think about US Treasury bonds, or think about a futures market for Fed funds. Think about a company hedging interest rate risk. That's all going to go through the rates desk, and that's actually the biggest part of the fixed income business these days. So switching gears to the next slide, let's go to page 11 and look at kind of compensation and headcount. Wall Street pays very well, but it's been stagnant over the years. So there's a couple of key things that have been happening. First, as revenue has been under pressure, the big firms on Wall Street have all been trying to figure out how do we make sure we're profitable and we're earning our cost of capital, even if revenue isn't growing. So one of the big levers they've pulled is modestly lowering the amount of revenue they pay out as comp, the comp ratio, that's in the top left over time. It hasn't been a huge shift in any given year. But you can see the dark blue line, which is the 4-quarter moving average. Most people on Wall Street actually get paid primarily once a year via bonus. That's been slowly grinding down from around 40% in 2011 to around 35, 33% being more typical today. Another big trend on the bottom left is the headcount itself has been coming down. So as revenue has been coming down, the number of people working on Wall Street has come down as well. If you look at the top 12 firms, it was about 60,000 people in 2013. It's about 53,000 today. So it's been slow and gradual, but generally you're seeing teams, desks, all shrink on Wall Street over time. On the top right, like other industries, Wall Street's been trying to make use of low-cost locations. So this is an example of Goldman Sachs, who now has its 4th biggest location being Salt Lake, Utah. When most people think of Goldman Sachs, they don't think of Utah, but it's the 4th biggest employment location for Goldman these days. And if you look at more broadly, they have 4 of what they call low-cost cities: Salt Lake, Bangalore, Dallas, and Warsaw. Those locations have seen growth in headcount over the past 6 years of about plus 4,000 people. While they're high-cost locations, the traditional places you think of, like New York, London, Tokyo, and Hong Kong, have come down by about 1,000. So jobs shifting to where the costs are lower. And then on the bottom right, this is something I've seen ebb and flow over my career. When Wall Street is booming, everyone wants to work there. When Wall Street's not booming, everyone else wants to work somewhere else. So this is using the example of Wharton. Wharton is the business school at Penn. It's usually thought of, as the most synonymous school with Wall Street. Everyone who goes to Wharton works in business and finance. The number of people going into finance, or the percentage of graduates going into finance, was 50% just before the crisis hit. It's all the way down to 30% today. And obviously the inverse of this is tech. I mean, if you look at where everyone goes to work coming out of the big elite schools now, fewer and fewer people want to come to Wall Street. More and more people want to go to tech. I would just kind of editorialize, as I've seen this ebb and flow over time. Usually it's a counter predictor, i.e. where everyone goes is just about to peak. So everyone wanted to work in Wall Street in 2000, just before the 01 downturn. No one wanted to work in Wall Street, and especially fixed income, in 2004, and that ended up being the biggest boom years. So these things have a way of evening out over time. Let's go to slide 12. When I started my career, you would have never heard, or hardly ever heard, the word technology when talking about Wall Street. Now it's everywhere. So one tangible example I used here on the left is if you look at Goldman Sachs earnings calls in 2005, the word technology or digital was mentioned 6 times. That's across 4 earnings calls, so hardly ever. 2017, last year, it was mentioned 26 times. And this focus is only increasing. So on the right-hand side, this is using an example of JP Morgan. As Wall Street firms have been under pressure to keep their overall expenses flat or even down a little bit, one area that's clearly targeted for growth is technology and investments in technology. So JP Morgan's tech budget has gone from $9 billion in 2015 to 2018. I'll use an example of a traditional bank, which is PNC, but their CEO, Bill Demchak, always has a tagline I like, which is tech budgets are never going to go down. The investment's only going to increase. And the goal is to decrease your headcount, compensation, and occupancy expense. So what does he mean by that? It's automating processes. It's making things more efficient. It's shrinking your real estate footprint. A lot of the investment in tech being made is trying to produce cost savings elsewhere in the bank. Having said that, it's not just about cost savings. There's been real systems being built to make clients' lives better, easier. When you say the clients of Wall Street, so for instance, in the equities business, our clients would primarily be mutual funds and hedge funds. Their ability to trade electronically, their ability to self-access our research via our portals and search functions and things like that. When I started in this business, we were still printing hard copy reports and physically sending it to clients. Obviously you would never do that today. That's just one small but tangible example of how technology is changing our business over time, much like other businesses. Let's flip to slide 13. A lot of times you'll hear about capital and risk in Wall Street. What does that actually mean? So first, on capital, there's various ways to measure it. One common metric is called tangible common equity to tangible assets. You can see the period pre-crisis, we got all the way down to 3.5%. Now we're all the way up to 8%. So capital is more than doubled. A lot of times you'll hear people quote the inverse of this, leverage. They're really the same metric. It's just whether you do capital divided by assets or assets divided by capital. So said another way, Wall Street used to be 33 times levered. Now Wall Street's only 12 times levered. Why is that important? Well, if I'm 33 times levered, if I only have a 3% capital ratio, if the value of my assets goes down by 3%, I'm bankrupt. We all work very hard to make sure we mitigate risk and we've got assets valued correctly and we don't make bad investments, but that's not a lot of margin of error. So one of the things that's made Wall Street significantly safer is just much higher capital levels, so you have a bigger cushion if things go wrong. On the top right-hand side, risk, there's various ways to measure this. One is quoted as value at risk. It's an estimate of, in an extreme scenario, how much money might you lose. So using JP Morgan as an example, their value at risk averaged 200 million in 2008. It's 100 million prior to the crisis. It's all the way down to 30 million today. So the business has become much more, you'll hear people say it's a moving business now, not a storage business. You used to buy securities on a trading desk, partly to facilitate client actions, but partly to make a bet, and you'd hold them and see if they went up or bet that they went down. Now that's much, much less common. It's really all about, what does the customer need to do? How's the quickest way for us to do it for the customer? How do we have as little risk as possible in that transaction? And lastly, regulation and compliance. Dodd-Frank for shorthand, but also the capital regulations for the banks are typically referred to as Basel. Basel III is the latest one. One way to show just how onerous, how much it's exploded, is just the page count of these documents. So post the Great Depression, the big financial regulation was called Glass-Steagall. It was 30 pages long. Post the most recent crisis, the financial crisis of '08, the big regulation was Dodd-Frank, or legislation, I should be saying. That was nearly 900 pages long. Similarly, the first global standard for bank capital, Basel I, that was 20 pages long. The most recent one, Basel III, is 700 pages long. So there's an army of people on Wall Street to work on compliance on this stuff. It's been a huge burden. Hopefully it's had some good that's been done to make the system safer, but it's also been a point of pain for all these firms over time. So lastly, on the Wall Street 101 bit, just page 14, let's try to give a little bit of a tangible example of one job, which is mine, an equity research analyst. So what do we actually do? Well, the most synonymous thing you would think about with a research analyst is the left-hand side, producing an actual report. They're PDFs these days. They're not physical reports anymore, but you can see what one looks like. This is just one we issued last week. That report might be looking at an industry issue. So this one is about Brexit and what impact that's going to have on the banks. It might be looking at a specific company. So you might do a report on JP Morgan and their revenue outlook, or Bank of America and their prospects for buybacks. But it's usually looking at the industry or a specific company in a research report. That's the most visible piece of what we do, but it's just one part. So what is the other stuff that would take up my day? We build and maintain earnings models, quarterly forecasts. So when you hear, the street estimates Bank of America will make 70 cents this quarter, that would be a collection of 30 analysts who have forecasts, including myself. We do calls and meetings with mutual and hedge fund investors. Those are our core client base. A lot of times we do bespoke one-off requests for those clients. So they may be doing a presentation, they may be looking for historical data, they may be looking to better understand an industry trend, and they would come to us for that. Sometimes people ask me, like, well, why aren't they doing that? They're investors too. The thing you have to appreciate about a mutual fund or a hedge fund is how small the teams often are. So you may have a large they employ their own analysts, but that analyst might cover 100 stocks or more. So they rely on their own judgment often to make the final investment decision. But in terms of getting the inputs they need, what does revenue growth look like at all these different companies? What are the key risks? What is management saying? What's their latest guidance? They just don't have the bandwidth to be on top of all that. And that's really the core reason that research analysts exist. We also host meetings with companies. So the management of a company, we might go in with 10 investors, talk to the CEO for an hour to better understand the business. We analyze quarterly earnings. So when the companies come out, I write a note, here's what happened at JP Morgan, here's what's important. And then we ask questions on the conference calls and at investor days as well. So again, when you hear Elon Musk gets in a fight on the Tesla earnings call, the person he got in a fight with is someone like me that's covering a different sector. So hopefully that gives a little bit of a tangible flavor of what a research analyst does. I guess the broader point here is that when I look back on my finance degree, it was very important for getting my foot in the door in Wall Street. When I look at how much of my day is actually using what would be in a finance textbook, it's some of it, but it's a surprisingly small piece. Understanding data series, long-term trends, being knowledgeable about the industry, being able to get along and be personable with clients, being able to be personable with the companies I cover. A lot of these skills, which really you don't get it all in a finance degree, ends up being more of what you do from a day-to-day basis. So maybe I'll switch gears, pause for a moment and switch gears on page 15, just switching to the lessons learned from starting a business, and then move over to page 16. So as I mentioned, we did a survey, about a dozen business founders. They were across various industries and various experiences. Some run a business that's just them. Others run a business with 100 people working for them. Some still run their business. Some started a business, it didn't work out and moved on. So I just stress that this is not just about starting a business in the financial industry. A couple of common themes really came out. I'll list off the themes first, and then we'll dive in more detail to what's on the slide. First and foremost, so I asked each of the business founders, email me 2 or 3 bullets. What was the biggest thing you learned from starting your business? Some flavor of the importance of people and getting the team right was first on almost everyone's list. So I just devoted 1 slide to it, but far and away it was the most common theme and the most popular theme. The second big thing is planning for your business, but also realizing how often you're going to have to go off plan. So we'll go into that in a little bit more detail. But one of the key learnings I can speak to personally, the business never looks exactly like what you think it's going to look like. You have to be willing to be flexible and change things over time. The third big learning was how hard it is, but also how rewarding it is. So it's not for everyone. A lot of times I'll hear people say, I want to start my own business for flexibility or to be my own boss. You might get that eventually, but you're going to have to work harder before it gets easier as opposed to a typical job. And then the last learning is really around some of the practical matters, advice around money, fundraising, legal, back office, and we'll get into that in a little bit more detail. So let's jump back into the slides, staying here where we are on page 16 and the importance of people. I won't read through every quote. Hopefully they're there. They're helpful for you. You can read them as I'm speaking. But the big flavor when you start a business, how much time you're going to have to invest in getting the people right and just finding the people. It takes a tremendous amount of time to interview people, to canvass your customers for referrals, to canvass former people you worked with for referrals, find the right people. And whatever you think the budget is for that part of starting a business, I can say from experience it's higher. The second big flavor here is once you've got the people, that's only half the job. You still need to build them into a cohesive team. So it's a little bit like, if you're a football coach, you can get all the players, but if everyone doesn't read from the same playbook and buy into the same system, you're not going to get very far. The last thing I'll highlight, and this is the last bullet in the middle section, that no matter how desperate you feel to hire people to get work done in the short term, it never works out to hire someone who doesn't meet your normal high standard. This is something that several people echoed to me. It's something I've heard a lot in my career. I don't even think it applies just to starting a business. It also applies just if you're running a team at a bigger firm. But just, it's tempting when you're starting a business, you got to hire 10 people. It's taking forever to just want to say, look, we got 3 resumes, just pick one. But the long-term consequences of getting the wrong person are pretty severe. So you really have to hold out and find the right person for the right role when you start a business. The second part of this slide is the people matter most, especially your business partners. It's just a couple of pieces of advice that stood out for me about specifically partnering with someone. So a lot of times you start a business, you may own a big piece of it, but you're going to have key partners who own other pieces of it. And just how, the common theme is how important that partnership is going to be and how you really have to choose that with care. You have to make sure it's someone you're comfortable with, someone who's on the same page as you, because ultimately this is almost like getting married to someone. So let's flip the page to page 17, talk a little bit about some advice from planning. So the biggest thing, top part of the page, the 3 quotes, is just, it's important to plan. It sounds obvious, but a lot of times people just have it in their head, I'll start a business and wing it. Like, you really do need to have a detailed plan, especially for the first 3-6 months. Where do we need to get to? Working backward from that, how are we going to get there? The other thing that resonated with me is this third bullet, the importance of starting a company in an industry you have experience in. It sounds obvious, but a lot of people think, okay, I'll start a business, I want to make a clean break from what I'm doing. It's going to be a risky bet. If you start a company in an industry you have experience in, you know what you're doing, you know what the competition is doing, you know who the customers are. Within this, the second part of this quote, understand your employment contract and what you can and can't do when you leave. It's a mistake I've seen a lot of people make over time. Generally, you're going to have some employment contract where you're working. You're going to risk violating it if you go and start a competitor. And I would just say the general advice I hear over and over again is it's usually not worth it. A lot of times you think, oh, it's going to be so valuable if I take this from my current employer. 3 months later, like, you don't even remember you have it. So, just making the clean break, understanding what's in your employment contract and making sure you don't trip any of those lines can really save yourself a lot of headaches down the road. The second part of this page, but don't get stuck waiting for things to be perfect. There needs to be a balance. So in this case, the person's pointing to, you can't plan forever. At some point, you just need to get started. And yes, you want, the perfect office, but at some point, you just need to pick one. Yes, you want the perfect setup, but at some point, you just need to move to get the ball rolling. So it's important to plan, but at some point, you got to turn the plan into action. Let's switch to page 18, recognizing the need to go off plan. So the plan's important up front. As time goes by, the plan will become less and less important because things are going to change. So you can see the various quotes here. They're all different versions of the same flavor, which is, when you talk to someone who's 2 or 3 years into a business, just ask them, how different is the business than when you started? It's going to be probably in the same industry. It's probably going to be something like what they originally outlined, but the products that are popular might not be what they originally thought they were going to be. There might have needed to be changes along the way in terms of where you're located or where you're selling or where you're having success. And you need to have that flexibility as you go through this. The last bullet really starts dealing with a complete pivot. Everyone loves that word now, to pivot a business. But there are points when you just have to change things completely. You might think, you're trying to sell one thing, it's not working. Something else has opportunity. You've got the team in place. You just have to pivot to what that opportunity is. So hopefully not everyone who starts a business goes through that, but it is more common than you would think. And you need to be able to deal with that if you get there. Let's go to page 19. It's rewarding, but it's not easy. Probably the quote, a couple quotes stood out to me here, but this very bottom one, it demands a roll up your sleeves work ethic, and you need to pick up a wrench attitude, especially in the early days. I can say from experience, when we started this business, I kind of had it in my head, I'm doing the same job. I was a bank analyst at Goldman Sachs. Now I'm going to be a bank analyst at Autonomous Research. 5 years down the line, that might be the case. But in the first 5 months, all sorts of challenges you don't think of, like, well, wait a minute, we need to get an office. Wait a minute, we need a copier. Wait a minute, we need to finance that copier. We need to get a bank to do that for us. And yes, you have a team and everyone's involved, but there's no other departments. At a Goldman Sachs, if I want to hire someone, I never think about what the employment contract looks like. I never think about answering their benefits questions. I never think about, where's the office going to be? It's self-evident where the office is going to be. That day one of starting a business, you got to figure all that stuff out. And, it's tempting to be like, well, I founded the business, I shouldn't be dealing with this stuff. But you really do need that pick up a wrench attitude, because at the end of the day, someone's got to do it. A couple other quotes that stood out to me: the hard work. You can see that in several of these quotes. The fact that you need to, this idea of an emotional mean line. There's going to be a lot of highs and lows if you start a business, and if you kind of let your emotions ride those waves, you'll end up bald, overweight, and divorced. So you need to have that emotional mean line and keep things calm. And this idea of don't do it for the money. Hopefully you'll be successful and you'll be rich, but in the early days, you probably make a little less starting a business than you would have just staying in a job. And certainly if it's only about the money, you run the risk of how long it's going to take and getting frustrated by that. So let's switch to page 20. Some practical advice here about money that people gave in response to the survey. So the first one, the big common themes that stood out are cash flow is really important, especially in the early days. If you run out of cash, you run out of a business. People aren't going to wait 6 months to get paid again, or suppliers aren't going to wait to get paid. So you really need to be on top of that as a business founder, or have someone on your team who's on top of that. And the second thing, I think a lot of times people take it for granted being at a big company. I provide a service, I get paid for that service. It's all pretty seamless. When you're actually running a business, getting customers and getting paid are not the same thing. So you need to make sure, what is my sales strategy? Who's in charge of sales? What is my collection strategy? How am I invoicing and getting paid? Because if you just take it for granted that if I provide a service, the customer's going to pay me, a lot of stuff can fall through the cracks there. I also like this last quote about having customer relationships before you start a company. Best case, have a customer who will give you business when you start. Worst case, have customers will take a meeting. But having that core group of supportive customers day one is hugely valuable. The second part of this page, some advice if you're raising money. A lot of businesses start with maybe a single investor or maybe the partner's money, so this isn't applicable to everyone. But some businesses do go out and raise money, maybe from a venture capitalist or maybe from a bunch of, a network of high net worth individuals. So a couple of bullets that stood out from that. One is take what you can get, especially in the early days, and don't get too bogged down in valuation or dilution. I personally, wasn't involved in any kind of VC or high net worth raisings. So I'll take the person at face value, but I think what they're really trying to get at, that first day, your business is just a piece of paper. So you can argue for ages about our year 3 revenue projection and what that means the business is worth and what percentage this person should get, but versus that person should get. It's important, but at the end of the day, don't get bogged down in it because, the plan is just that, it's a plan. Ultimately what you're trying to do is be successful. And if I can get more money that's going to help me grow a bigger business, having a small share of a big pie is a lot more valuable than having a big share of a pie that never gets off the ground. And the second quote points to that as well. It's having that headroom, having that a little bit of extra cushion. The odds are stacked against you when you start a business. So anything you can do to tilt the odds in your favor is really important. And lastly, we'll flip to page 21, the plumbing, as I deemed it here. I wasn't expecting to get these answers when I wrote people, give me your top 2 or 3 findings or lessons learned from starting a business. But several of them included it, usually some version of legal, accounting, or back office. So I guess the main point is, that stuff's important, and unfortunately it does fall on you if you're founding a business. The common themes were, making the extra investment to have the right team and the right advice. I can remember personally a legal bill at the beginning when we started the business that was painful, but as someone pointed here, $5,000, $10,000 legal bills can seem awful when you're starting a business, but if it's for something really important like how you're incorporating, it's worth it to have the right advice. Other words of advice here, never underestimate the importance of the back office, having the plumbing of your business set up right, because a lot of times, if a customer has a problem with the front office, you can talk to them, talk your way out of it. You can provide, say, I'm going to give you something on the next deal, or I'm going to help you out, or I'm going to make sure this gets fixed. Operational snafus can be really painful because now you've got a customer, they're getting yelled at by their back office or their CFO. we ordered this, it didn't come through, the invoice is a mess, we're not getting the right legal documents we need to sign off on this as a supplier. So having that back office in place is really important. And then the last piece of advice, a good accountant who really knows your industry can be a really valuable sounding board as well. So let me pause there. That concludes the slides. I guess the last slide, page 22, we can just leave. It's the disclaimers for having just talked about the importance of legal. There's our legal. So for anyone who is interested in reading our disclaimers, there they are. And with that, we'll pause for a second on Q&A, and I believe there's an online way to submit questions, and happy to take any that people have.
Thank you, Brian. We do have a couple of questions. I put them in the chat box.
Oops. They are not coming up on my end. Would it be possible to read one or two, Elvis?
Absolutely. This should be in a top left, the blue little chat box. So basically, we have a question from, is there one item that's, do you see him? Okay.
I see it now, yeah. Okay, so let me take a couple of this. Is there one item that stands out as more important in seeking funding? Okay, so I'll just give some perspective I have on this. It wasn't something I dealt with a lot in personally starting a business, but speaking to people who've done it, having some relationship with the people you're trying to raise money from. I know it sounds obvious, but there's a wide range of ways businesses get funded. Some will get funded by a venture capital fund, some will get funded by a bank, some will get funded by a high net worth individual. But the biggest thing that stands out to me when I talk to other people who have founded a business and went through it, usually there's some connection. Someone introduces them to someone, they know someone, they're out of their personal network. And like I said, it sounds obvious, but if you just walk in out of the blue and the person doesn't know you, often it's very hard to even get their time, even get their time to pitch them the business. So maybe taking another one, when earlier you noted a Stark decline Wharton grads not moving into finance, any data on where they're going instead, like the tech center, et cetera. I don't have that offhand, but tech, I know looking at my alma mater, I noticed the same thing in some recent survey they put out. It's like a third of where people go now. And speaking of that ebb and flow, so I graduated school in 2001. When I was a sophomore and a junior, everyone wanted to be in tech. And by the time I graduated, tech was like death. That was the last place you wanted to go. So these things are cyclical. I don't think people will not want to work on Wall Street forever. But right now it's obviously a little bit out of favor. And a lot of that reflects the revenue trends. Tech is growing. There's a lot of need to add people. Wall Street's not. Okay, and additionally, do you find your professional trade knowledge allows you to capitalize on any private financial sector equity investing and gains, meaning knowledge, not insider info? Thank you for that disclaimer. We generally try to avoid anything that would be capitalizing on the business. So let me speak to you about research specifically and then Wall Street more generally. In research in particular, the rules around investing and anything you cover have become much more constrictive over time. So it's always been the case you're not supposed to invest in the companies you cover directly, but over time, most firms have broadened that. Some firms don't let you invest in any firm stock covered by the firm. Most firms don't let you invest in stocks in your direct sector anymore. So as a research analyst, not really. More broadly on Wall Street, yes, you do see that. People who are in banking or private equity or real estate, usually it's not so much as part of their job or even, when they're in the job. Usually it's the second stage of their career when they can transition into running a fund or making private investments. So over time that can be monetized. I guess I could do the same thing. It wouldn't be stocks covering anymore. But generally it's that second phase of your career as opposed to on a day-to-day basis. Okay, next question. If you had a functional idea How would you recommend getting funding if you are a young 27-year-old entrepreneur and haven't earned enough credit yet? How can I find mentors and advisors? I don't have a great answer. I know personally, the school I went to, a lot of schools seem to be doing this more now, has like a angel venture club, and you see a lot more networking events for that kind of stuff. That could be one avenue. Yeah, I guess I'll leave it at that because I don't have a great answer for that one. Is getting venture capital better than getting a bank loan? Honestly, if you don't have any revenue, you're probably not going to be able to get a bank loan. So your choices, if you're thinking of funding a business with bank debt, really start talking more about personal debt. Most of the banks, well, frankly, just regulatory and capital rules don't let them fund a business that doesn't have cash flow or collateral. So, most startups won't have either. And typically, if you see bank funding for a startup, really you're talking about one of the founders of the business taking personal debt and using that as opposed to venture capital, which is better. I mean, using your own money is going to be better if you're sure the business is going to work and then you own all the equity down the line. But obviously you're putting your own money at risk. Not every business makes it. And if you go the venture capital route, you have less upside, but you also have less downside to things that don't work out. I recently passed, next question. I recently passed CFA level 1. I'm trying to break into the finance industry. Do you have any advice as to how to leverage this? So let me touch on the CFA and then, maybe some advice on how to leverage it. I found over time, and I'll touch on MBAs as well. Maybe it's a related question. When I started on Wall Street, I didn't have a CFA or an MBA. And I came in as an associate. It's kind of like the middle tier. Usually you have an analyst as the junior tier on Wall Street, associate as the next tier, vice president as someone who's now running something, and then a managing director is someone who's in charge of a whole team or a little bit bigger job. So that's the typical pyramid on most Wall Street functions. It really doesn't matter if you're in research or banking or whatever, you'll typically see that structure. So when I started on Wall Street, you could be an analyst if you had a college degree. If you wanted to be an associate, it was pretty rare to be an associate without an MBA or a CFA. The early to mid 2000s is when you started to see that change, and ever since, it's just been moving more and more in that direction. I.e., industry knowledge is as valued, if not more valued, than the MBA and the CFA. And the MBA and the CFA are no longer a requisite to be a senior person on Wall Street. And if anything, they're becoming a little bit more rare. So then what's the value of a CFA for those pursuing it? Really it's the foot in the door value. If you don't have, I was lucky enough to be a consultant for the financial services industry. So that was my foot in the door. That was my industry experience. If you don't have that, you're majored in college, but didn't do a finance major and are now trying to transition, or you're trying to transition from another industry, pursuing a CFA on your own, it can be a little painful, frankly, but it can demonstrate to someone's interviewing you, I'm willing to personally invest in this. I've taken the time. I've put up some money because it costs a couple $1,000 for each level. And I'm demonstrating the interest. This is something I really want to do. But it is very much going to be that foot in the door, as opposed to, hey, you have a CFA. People are just looking to hire someone with a CFA. Let's see. A couple of these I'll skip just because I don't have great perspective on, so I don't want to mislead someone. When hiring employees, what are some of the legal forms initially required? Look, it's going to be different depending on the industry and depending on the seniority of the employees, but you're probably going to need an employee contract for some of your senior people. One of the bullets that I think might have actually got a little cut off on the slide deck, but someone who responded to our survey made the point, bear with me while I just find the bullet. So when starting a business and getting partners, don't worry about giving away equity for good people. It's worth it, but do worry about vesting over time and how to part gracefully if things don't work out. And I think the reason I bring it up in relation to the employee, what do I need in terms of employee contract? You should find a lawyer who's helped some businesses get started. They should be able to help you with a template that makes sense for your business. But beyond what's in the legal contract, I think people often plan for, I want the contract to spell out everything that's going to happen while the person is at the job. And it's not actually that valuable for that. It's not like you're not going to walk to one of your partner's desk with the employment contract and start arguing with them about the way they're writing an email or something. Or if you do, you're probably not going to be partners for very long. But I think what sometimes people forget when they're starting a business, maybe you start with a team of 3, maybe you start with a team of 10, maybe it's, you're well funded and you start with a team of 30. But any job is going to have turnover over time. And if you think your business is going to be around for 5 or 10 years, even an exceptional business is going to have turnover approaching 10% a year. So you just think through the math. If I've got 20 people in business for 10 years and 2 people a year are turning over, over time, people are going to leave. And you want to plan for that. How are you going to part gracefully? If the person owns a stake in the business, what does that look like if the person leaves? It's always a uncomfortable conversation to have because you're starting a business. No one wants to be the person to raise their hand and be like, yeah, I'm going to leave in 6 years, but someone around the table might. So having a legal contract that does a good job outlining what that looks like and making sure it works for everyone is important. Okay, so let me just see, there's a couple of comments here. I'm just seeing if there's any last actual questions. Okay, I think there are 1 or 2 other questions, but they're kind of outside my area of expertise, so I'll skip them. Elvis, maybe a last call. Are there any questions that I'm not seeing in the chat room, or have we exhausted them at this point? I think the silence means we've exhausted them. Well, thank you everyone for joining. I hope it was helpful. And I'll leave it at that. Thanks everyone, and have a great day.
Thank you, Brian, and thank you all for watching, and please stay tuned. We have next month upcoming webinars as well, so I'll stay tuned, and I will send this recorded session link later today, and I will ask Brian to see if he's willing to share the slides with you guys. Thank you.